Hello, Business 630 students. This is Professor Hassey. It's our lecture video for week number 3, September 6th through September 12th. This week, we're talking about chapter 7, which is calculating stock prices using risk analysis. The key phrase here is the required rate of return on a stock. What do investors expect as a return, and how do we calculate that using market indexes, using risk, using beta information, and determine that value required rate of return. And that's a key part of our strategic study as we get into our case analysis in a few weeks. I have posted the group teams for this week. We have 9 teams. 2 teams have 4 students, and then 8 teams of 3 students. And you have been put in areas. I've sent you an email this evening to let you know the groups. I will be having a video this coming weekend explaining the electrics case. It is due on October 17th, explaining your responsibilities in that case as a team. And I urge you, once you see that video, that you get in touch with your group members. Your groups are listed in your Blackboard, and you can click on the group and see the email address, send emails just to your group members, and begin the correspondence. But don't do this. You can do this, but you won't have any information to talk about until I post this video this coming weekend. Besides that, you're working on a case that is due on this Sunday. It's a risk analysis case to determine the viability of a company in your portfolio. And I'm going to go over that just a minute. We had an introduction video on that this past weekend, and I've set up a rubric for the case so you can see how I will be grading it, which will help some students. And also I'm available for questions or during this course of the coming weekend, but this case is due on September 12th, Sunday. And if you have any issues with it, please let me know. I have posted a rubric in the case study number 1 file folder in Blackboard, which explains the grading of this. Remember, this is a paper that is to be provided that you are to put together using a risk evaluation of this first part here of a company, and then the second part doing an organizational and an environmental perspective of the risk associated with your company. Okay, this paper is an APA format paper. 5-page limit, a minimum of 5 pages, a maximum of 10. But you already know that 3 of the pages will be the title page, the abstract page, and the reference page. So 3 pages are already accounted for. So you are to put your information concisely together and organized in a manner that explains the risk of the company that you have selected. Here's the rubric that I have posted to the case folder. This is a standard MBA rubric of what the expectations are to get an A, a B, or anything lower based on the type of work involved. So please, if you're a little bit confused what I'm looking for, this gives you a little bit basics of how I will grade case studies in this class based on certain criteria: completeness, understanding, analysis, evaluation and recommendations, research, and writing mechanics. These all play a part in the overall grade of your casework. So look this over if you're a little bit confused about what I'm looking for and what the types of how you are to write this. This might help some of you. And if you've never done much casework before until this class, this rubric will be maybe help you and guide you. If you still have a little bit of questions or confused about this, be sure to let me know. You can email me, you can post to the discussion forum and in the general discussion forum by week 3. You can contact me via email, and we can set up a Zoom session if so desired. So there's a lot of ways to ask me questions before Sunday, and I will be available all this weekend. All right. Okay. A couple of things that are very important to get out of chapter 7. We're finishing up our introductory sessions here of the first couple of weeks, and this week we're talking about risk valuation and risk analysis. One of the key points of critical analysis, critical strategy in finance is, what do our investors expect us to pay them? In order to keep them investors, what do they expect as a return on their investment? That's a key factor in what assets we select in investments, how we manage and operate the cash flow and the expenses and revenues of a project. It plays a lot into what our investors demand. Okay, and that's you can't stress that enough. Is, as a financial manager, you need to not only know the market conditions and how you operating your company, but what do your investors want? If it's a debt, if they're lending you money, that's pretty straightforward. If you lend money, you have to pay back the principal, and you have an interest rate on that debt, and that interest rate is usually determined by the credit rating of your company in the market. But with stock, it's a little bit different. Matter of fact, very different. In stock, it's a variety of things. Remember, when you issue stock, you are probably going to pay dividends, and you're probably going to make sure that stock price grows over time. Combine all those and you get a required rate of return. In other words, if you're going to buy stock in Home Depot, you're not just buying the stock because, oh, I don't have anything else to do with my money. You're buying Home Depot stock because you want to be paid a return on your investment into the future. It's the company's responsibility to come up with that return. And that return can be in two areas: dividends and or stock growth. Now, the only way to get the stock growth is you got to sell the stock. But still, that's how you get a return off your investment. So companies are constantly looking at how in the market, in the risk of their company in the market, the risk of the assets or the projects they're involved in their company, how does that all equate to what our investors expect as a return on investments? One of the reasons why I'm having you do case number one is I want you to assess and understand the various things that you can do to assess the risk of a company. Not only is it risk of credit ratings or betas, it's also, or the capital asset pricing model, expected return on investment, but it also is organizational risk, market risk, environmental risk. There's a lot of factors that play into investors' demand based on the risk of your company. So this case number one asks you to assess that and learn that. And then as we now go forward into our next case, which is coming up next in another week or so, is, well, how do we take that risk and apply it to a specific project or a specific investment of capital? Well, one of the ways of determining this risk is called the constant dividend growth model. You can determine the price of stock in the market based on the dividends you expect to pay in the market in the next year, that's D1, based on the required rate of return on the stock that investors want, minus the growth rate that the company anticipates growing at in the next year. And if you put those together, you can determine the expected stock price that the investors should want to achieve these returns. Now, I'm going to show you a couple of videos that are in our YouTube playlist that are very good at highlighting this. So let's take a look at those videos.
I'm going to do an example using the CAPM model to find the required return on an investment. Different textbooks have lots of different notation for these things, so I wanted to write out the formula without any notation. The required return on an investment is equal to the risk-free rate plus the beta of the investment multiplied by the expected market return minus the risk-free rate. We have an example here. It's probably the best way to show how this is done. Find the required return on a stock with a beta of 1.7 if the expected market return is 10% and the risk-free rate is 2%. A couple things that might pop up. Risk-free rate, a problem will not necessarily always say risk-free rate. It may say the rate on a 3-month treasury, or it may say the rate that you can get in a risk-free investment. So look for that to find the risk-free rate. Also, to clarify, expected market return means what you expect the overall stock market to return. Here that's 10%. So using our formula, it says it is equal to the risk-free rate 2 plus the beta 1.7 times, open parentheses, the expected market return 10 minus the risk-free rate 2. We're going to close parentheses, and before I hit enter here to get the answer, a couple things I want to point out. You'll notice I used the percentages here, 2 and 10, rather than 0.02 and 0.10. I will do it the other way in a second to show that it actually doesn't matter. Second, if you were doing this by hand, remember the order of operations is going to require you to do the 10 minus 2 first because it's in parentheses. You'll get 8. You then need to do the multiplication, 1.7 times 8, before adding 2. Excel will do it in the correct order, but if you're doing it by hand, please remember that. We'll hit enter. It gives us 15.6% as the required return on this stock. So we must require this stock to earn 15.6% in order to justify the risk of owning it. Just to show the percentage form, if we do equals the risk-free rate 0.02 for 2% plus the beta 1.7 times the expected market return 0.10 for 10% minus the risk-free rate 0.02 for 2%, you'll notice that we get 0.156, which is the same answer, 15.6%. Just note one final thing. Beta is not a percentage, it's just a plain value. So no matter how you do this problem, beta will always go in as 1.7.
The problem we're looking at in this video is something called the constant growth model, also known as the Gordon model. Okay. So let's set this problem up, and we have let's call this company the Tolland Company. And the Tolland Company for some time has been paying a dividend of $3 per share. Well, the board of directors just recently met, the BOD just met, and they said, hey, we're going to increase our dividend by 8%. That's great news. They're going to increase the dividend by 8%. Well, you as an investor have some sort of expectation, and you expect to get back a 12% return each year. The question would be, in order to do this, what would be the most you are willing to pay if you expect a 12% return, pay for the stock? Well, let's set this up here. So the problem looks like this. It's PO, that's the price, is equal to D0, which is dividend 0, or the first year, right? Dividend, right? 1 plus G divided by K minus G. That's a small k. Sorry if you can see that, K minus G. So it is 1 plus G. Now G is growth, K is interest, D is dividend, and P is price. So we have had a constant dividend of $3. So DO is $3. And now we're going to take the 1 plus, we are going to have an 8% return. So 0.08. 1 plus 0.008 divided by the K, which is small k, which is 12%, minus the growth, which is 8%. This is 0.08. So that's how it's going to look. So then what we are going to do is we are going to multiply 3 times 0.108, so 3 times 1.08, and that will equal $3.24 divided by 0.12 minus 0.08, which would equal 0.04. So it's a very simple division where you take the 324 and you divide it by 0.04, and then you would come up with a price of $81. So based upon the Gordon model for this company, Tolland, if you were to receive a $3 dividend and you had an increase of 8%, that's what the board of directors is going to do it, and you expect a 12% return on your investments each year, what would you be willing at the very most to pay for the stock in order to get this? And the answer, after you do the little Gordon model calculation, is $81. Thank you, and that is your answer.
Okay, we've now seen two video examples of how to determine the required rate of return on a stock using the capital asset pricing model, which is a little bit of a help for some of you who are doing case number one. You have to do that calculation for your company. But also that required rate of return is used as the K in the second video to determine the stock price, which will give you the required rate of return and the dividend projected by the growth rate of the company. But what happens if the dividend in that second video is never constant? It's non-constant. In other words, the dividend is going to be one dividend one year and then another dividend the next year, which usually happens in business. So how do you calculate the stock price if you have non-constant growth? Again, these are all leading up to strategic decisions. And I know a lot of you probably studied this before in another finance class, but if you haven't, or it's been a while, it's good to refresh ourselves with these calculations because we're going to be using those over and over again in the coming week, especially in your electrics case that you'll be doing in another week or so. So let's take a look at this video. Okay, three different styles of videos, but all going after the same purpose. If somebody's going to invest in stock in your business, what are they going to get out of it? What are the expectations out of that? You determine the required rate of return, or K, as they call it in the other two videos. That's what the stockholders expect to earn. Then you have two different models of determining the stock intrinsic or present value by using a constant growth model for the years that the growth is constant or the same, and then combining that with a non-constant growth growth when it's 20% for 2 years and 5% after that. And that's called a non-constant growth model to determine the stock price. These are where financial managers use this to make sure that they can provide the adequate return for their investors. So they'll give them the capital to invest in assets, or once they get the capital, they can manage those assets, profits, cash flows, to generate the return that's demanded by the stockholders. And again, the difference between that and the capital you receive from lending money or borrowing is lending, you just have to make the interest payments on a regular basis and pay back the maturity. With stock, it's a lot different. You have dividends, you have growth rates, you have constant required rate of returns. It's a little bit more involved. But put all that together, and it's what the investors expect to get from the company. And in the role of the financial manager, the person who's in charge of making sure these investors are happy with selecting assets and returns that are going to meet those demands for capital and keep the company competitive in the marketplace. That's what we're talking about in risk analysis. And what you're solving in case number one is your company, in your interpretation, meeting those risk qualifications to compete in the market based on their credit rating, based on their required rate of return by the capital asset pricing model, based on their organizational or environmental or market relationship with risk. Combine all that, and we're getting some basic guidelines of which we start making strategic decisions for investing in assets using capital acquired from the markets. So that's our study. So in this week, you're finishing up case number one this weekend. As I said earlier, I'm available all weekend if you have questions or concerns. There's a rubric now to guide you in what you need to do in that case. Then next week, we are going to talk about this weekend. I'm going to do a special video introducing the Electrics Group project. Your teams have been designated, and you can start getting that organized. And in the meantime, we'll have another case coming up and additional reading and study, but we'll talk about that in our introduction video this weekend. So if you have any questions, please feel free to ask me, but that's where we stand right now after week 3. We head into week 4 next week, looking at the cost of capital and capital budgeting, which is a very important tool of taking the information of risk and our return demands of our investors and selecting assets to invest in that are going to meet these guidelines. And that's in week 4 of next week. There's no case next week. Our next case is in week 5. But you can begin working on and organizing your team next week in week 4 on your electric case and putting that together, of which we'll discuss these next few days. Confused? Don't worry about it. We'll get it all straightened out. Everybody have a great rest of the week, and we'll talk to you soon. Adios.